Stocks stage a major comeback today, but there could be a big overhang in the second half of the year for the market. Leslie Picker joins us with more on that angle. Leslie.
Hey, Wolf, that's exactly right. The markets have stabilized today, but one key technical risk is in store for the second half of the year: lockup expirations for those hordes of IPOs that debuted in the first half of 2019. Now, this allows company insiders to sell usually about 6 months after a listing date. It also means a massive amount of supply could come onto the market, pressuring prices even further. A CNBC analysis found that an estimated $215 billion worth of stock will become available for trading during the remainder of the year. That's based on the $38 billion worth of stock listed in the U.S. during the first half of the year, representing about 15% float on average on the average IPO. And while not all insiders will sell into the lockup expiration, not even close, the potential for this rush of supply already has people nervous. Some analysts and investors have said that the limited float of recent IPOs has helped support the stock for the first half of the year, but once the lockup expirations start unfolding, that supply-demand dynamic could shift. Now, this could also be why you're seeing new IPOs like WeWork push up their timelines to September to beat the flood of stock from the deals in the first half, guys.
Leslie, just quickly, specifically on one name on Lyft, what was the news today that the market wasn't aware of that pulled the shares back after hours?
So this is really interesting, and it's very, very unique because usually companies do abide by that 6-month window before allowing their lockup to expire. Now, Lyft had something in their S1 that basically said that if their lockup expiration coincides with the blackout period surrounding their earning, they actually can move their lockup expiration date forward instead of backward. Usually you see companies that will actually delay that lockup expiration because once the expiration happens, you do tend to see, on average, the stock price decline. Now, Lyft is saying we're actually going to give our insiders a chance to cash out earlier rather than later.
Why? Is that a bad sign, Mike?
It shows a little more urgency to let insiders get out. I mean, I think incrementally it's not great, although it probably doesn't change the overall picture longer term in terms of how much stock is ultimately going to be sold.
Presumably they knew this was going to happen. They could have released it.
Could easily have known when the blackout period was likely to be.
So it is a bit sneaky one way or another. Leslie, thank you very much.